Welcome to the deep dive. Today we're asking, well, a pretty big question. Can a 99-year-old student house in Ljubljana, Slovenia actually be a blueprint for the future of digital asset ownership? We've got this fascinating analytics report on a tokenized property right here. And our mission today is to peel back every layer, every number, to see what makes this unique investment tick. And maybe more importantly, what you, the informed investor, should really look for in these kinds of reports.
Absolutely. What's fascinating here, I think, is how these reports pull together so many different data points.
Yeah.
You got asset valuation, debt structure, local market conditions, and it's all tied into this digital ownership model. We'll try to explore how all these details connect, hopefully helping you connect the dots yourself.
Okay, yeah, let's unpack this. Right, let's start with the star of our show, this co-living student house, 24 rooms. It's at Ljubljana Husa 16, right in New Ljubljana, Slovenia. So a multifamily residential place, urban area.
hmm And this property, it's been a consistent player in the current owner's portfolio for, well, nearly 6 years, 5.89 years to be exact.
Yep.
And it's classified as being in fair condition, which, for a property almost a century old, that implies pretty decent upkeep.
Okay, so given its history, its age, that condition, what immediately stands out about its performance historically?
Well, historically, it's yielded a really impressive annualized return on investment, the ROI. It's 15.14%.
Wow, 15.14.
Yeah. For context, many stable real estate investments might aim for maybe 6% to 10% ROI. So this property has been performing notably well in its historical run. Its current market valuation stands at $950,000. And that's up from the purchase price 5.89 years ago of $640,000. So that's an appreciation of 48.44%, a really strong gain over that period.
Right, that 48.44% is definitely strong. But I did notice the report mentions this valuation is an owner estimate. How much weight should we really put on that? And what are the implications maybe for token holders who are banking on that specific valuation? Also, let's touch on those the BSPT tokens. The report says the property can issue up to, 61,085 of them?
Yeah, that's a really astute observation about the owner estimate. It absolutely highlights the importance of, critically evaluating where the data comes from. It might be a perfectly reasonable estimate, maybe even conservative. But yeah, external verification would definitely add more confidence. And as for the tokens, right, this is where the tokenized aspect really shines. You can imagine owning a small liquid piece of this building through those BSPT tokens.
Okay, so we've sort of laid out the physical asset, but now the cutting edge part. How does it actually become tokenized? For someone curious about this, what does this digital ownership model mean in practical terms? How do these BSPT tokens work for investors?
Right. So this property token offers digital ownership.
Mm-hmm.
There's a capped supply of 61,085 BSPT tokens available right now, though the maximum potential, the report says, could be up to 100,000 tokens eventually.
Okay.
The current circulating supply is 30,000 BSPT, and each of those is priced at $9.50 USD. So that leads to a market cap of $285,000, but that's just for the circulating tokens.
Ah, right. Important distinction.
Exactly. It's different from the property's total valuation of $950,000.
Yeah.
It's kind of like a company having outstanding shares versus a larger pool of authorized but unissued shares. This structure gives the owners flexibility maybe to issue more tokens later to raise capital. But for current token holders, it means they own a share of the current revenue and appreciation represented by that circulating supply.
Got it. So for these circulating tokens, what kind of returns can holders realistically expect? And what do those ratios, the price to earnings and the operating expense ratio, tell us about the token's value and, I guess, the property's efficiency?
Well, investors can expect an estimated annual percentage yield, an APY, of 15.14%. That's from a combination of rental income and property appreciation. It aligns pretty closely with the property's historical performance we mentioned.
Okay.
The report also gives us a price to earnings, or PE ratio, of 9.8 for the tokens. This basically indicates that for every dollar of earnings the token represents, the market values it at $9.80. A lower PE, like this one, can often signal a more attractive investment from a value perspective. You're paying less for each dollar of earnings.
Makes sense. And the OER.
Right, the operating expense ratio, OER. It's 37.84%. That's the percentage of the gross income that gets used for operating expenses running the place, basically. So this OER gives you a clear picture of how much of the income goes towards managing and maintaining the property before you get to profit.
Okay. Now, while the property itself is key, it doesn't exist in a vacuum, right? It operates within Slovenia's broader economic environment. Our sources give some intriguing insights into the national market conditions there. How do these national trends impact a specific asset like this student house?
That's a great point. If we connect this to the bigger picture, Slovenia's 22-year average inflation has actually been 48.55% lower than the global benchmark. And interest rates have averaged about 28.14% lower, too.
Lower inflation, lower rates? It sounds pretty good.
It is significant, yeah. It suggests a more stable, potentially lower-cost operating environment for a long-term asset like this. It reduces the risk of, say, rapidly increasing costs or financing challenges.
Right, but then there are other factors that paint maybe a slightly different picture, like Slovenia's average GDP growth over 20 years has been almost 30% lower than the global benchmark, and unemployment has averaged about 6.35% higher. What does that tell us? Is it dynamism versus stability? How might that influence what investors expect from this property?
That's the crucial tension, exactly. The lower inflation and interest rates point to stability, which is great for consistent cash flow from rents. However, the trade-off with lower GDP growth and higher unemployment suggests that, well, while the property's rental income seems robust, probably due to specific student demand, investors shouldn't necessarily expect rapid capital appreciation driven solely by a booming national economy.
Okay.
It kind of reinforces that the property's individual performance, its location, its management, that's paramount for its success, rather than just riding broad economic tailwinds.
Right, that makes sense. Let's circle back then to the property's worth specifically. We're evaluating it as a potential investment. We know it was bought for $640K, now valued at $950K, that 48.44% appreciation. Beyond that headline number, what do the annualized ROI, the CAGR, and crucially, the cap rate tell us?
Okay, so the annualized ROI, again, 15.14%. That includes both the price appreciation and the rental income. The compound annual growth rate, or CAGR, is 6.93%. That shows the average annual appreciation rate, factoring in compounding over time. Now, the capitalization rate, the cap rate, it's 10.02%. This is a really key metric in real estate.
Yeah, always hear about cap rates.
Exactly. It reflects the rate of return based purely on the net operating income the property is expected to generate relative to its value. For a well-established residential property like this, a 10.02% cap rate is actually quite strong. It indicates good return potential.
How strong is that typically?
Well, in many urban markets, residential cap rates might range anywhere from, say, 4%, maybe up to 12%, depending heavily on risk and location. So this higher rate suggests a pretty robust income stream relative to its value. Makes it potentially attractive for income-focused investors.
Okay.
However, and this brings us back to your earlier point, it's vital to remember the valuation source is listed as owner estimate.
Right, the caveat.
Yeah, and that can influence the trustworthiness of that cap rate calculation.
Yeah.
It's just a reminder, really, to always consider the source of the data and its potential impact.
Got it. Okay, so beyond valuation, a property's real muscle comes from its income engine, right? Let's shift focus to how this student house generates revenue and keeps those rooms full. We see a gross annual revenue of $155,977 and a gross rental yield of 16.41%. Pretty healthy numbers.
But what's particularly striking and frankly quite remarkable is the occupancy. Total capacity and actual occupancy are both listed as 31 tenants.
Wait, so a 0% vacancy rate?
Exactly. 0% vacancy. It indicates full utilization and, well, incredibly strong demand for these co-living spaces.
Wow, okay, 0% vacancy for a student house. That's amazing. In some markets, that seems almost too good to be true, given the turnover. How do they achieve that, especially in student housing? Are there specific strategies or market factors here ensuring that consistency? And what does that imply for the stability for token holders?
That's an excellent question because you're right. Student housing usually means high turnover. The report notes a short lease maturity, just 0.29 years on average.
Right, so constant retenanting.
Yes. So that consistent 0% vacancy strongly points to exceptionally high demand for student housing in Ljubljana. Perhaps there's limited supply, or this property's location is just prime. It's also likely a testament to highly efficient property management, really streamlined leasing process.
Makes sense.
And for token holders, well, full occupancy means consistent rental income for the property, and that flows through. Plus, the tenant concentration rate is low, only 3.23%. So no single tenant dominates the income stream, which adds stability.
Right.
And payments are 100% monthly, regular, predictable income flow.
Okay, solid income picture then. Let's shift to the people behind the property, the ownership. It's under company ownership. There are 5 owners holding 20% or more, and they've held it for that same 5.89 years. What does this structure tell us about, say, management and long-term stability?
Well, the cumulative ownership duration is an interesting figure. They calculate 29.45 years. That reflects the sort of collective experience these owners brought to the table. The average duration, 5.89 years per owner, indicates a pretty consistent group that often translates to stable management and probably a clear long-term vision for the asset. Okay. And when we look at the ownership concentration, it stands at 22.22%. What does that tell us about decision-making? Any potential influence dynamics? Right. So 22.22% reflects how much the single largest owner holds. That level suggests that while there's a significant stakeholder, it doesn't represent a controlling majority on its own.
So more collaborative, maybe?
It could imply a more collaborative decision-making process among those 5 major owners, or at least a situation where multiple voices carry weight, which, can be positive for balanced governance.
All right, now let's talk debt. That can obviously significantly impact financials and risk. The sources show there's one debt facility, it's a senior facility, total outstanding debt, $230,000, and the annual servicing cost is $28,871.04. How well-positioned is this property to actually cover that debt?
That's a critical area, absolutely. First off, the loan-to-value ratio, the LTV, is low. It's only 24.21%.
Okay, low LTV is good.
Very good. It means the loan is a relatively small portion of the property's overall value. Signifies a very strong equity position. From a lender's viewpoint, that's excellent.
And what other indicators really highlight the financial health in relation to this debt?
Well, look at the interest coverage ratio, the ICR. It's a robust 8.96. That tells us the property's earnings are almost 9 times what's needed just to cover the interest payments on its debt. Think of it like a huge safety cushion.
Okay, yeah, nearly 9x coverage.
Exactly. Similarly, the debt service coverage ratio, DSCR, is 3.36. That indicates the property generates $3.36 in net operating income for every single dollar of total debt service principal and interest.
So plenty of cash flow after paying the debt.
Plenty, and the debt yield is 42.13%. That's exceptionally high. It illustrates how much net operating income is generated relative to the total debt amount. And finally, the loan constant is 12.55%. That just shows the annual debt service as a percentage of the total loan. All these figures together, the low LTV, the high coverage ratios, they paint a picture of really excellent financial health and a very, very manageable debt burden for this property.
Okay, that sounds very solid on the debt front. Finally, let's touch on the property's age and its ongoing operational costs. We mentioned it's 99 years old, condition listed as fair. What do the estimated annual expenses tell us about the cost of maintaining an older property like this?
Right. The total annual expenses are estimated at $59,000. Within that, the specific maintenance expenses are $18,000 per year. That results in a maintenance expense ratio of 11.55%, meaning about 11.5% of the rental income is dedicated just to upkeep.
Is that reasonable for an older building?
Yeah, for an older property classified as fair, that's a pretty reasonable allocation. It shows they're actively investing in maintaining the asset, which is important.
Okay. And when we factor in all the costs, what does that total expense ratio, the OER we mentioned earlier, reveal about overall efficiency and profitability?
Right. Taking everything into account, that total expense ratio is 37.84%. This is important because it gives you that clear picture. Roughly 38 cents of every dollar of gross income goes towards managing and maintaining the property before you arrive at the net operating income.
And is 37.84% good or bad?
For a multifamily property, an OER in this range, say high 30s, is generally considered pretty healthy. It leaves a significant portion of the income, over 60%, for debt service and profit, which definitely aligns with the strong cap rate and the excellent debt coverage ratios we just discussed. It all fits together.
Okay. So pulling this all together, what does this deep dive mean for you, the listener, the learner, trying to understand tokenized real estate? We've really unpacked the specifics of this one property valuation, income, debt, the token structure. You've seen how a comprehensive report like this provides this layered view, telling a pretty fascinating financial story.
Yeah, I think this deep dive really highlights that while the tokenization part is new and exciting, the underlying real estate fundamentals, valuation, occupancy, debt management, those remain absolutely critical. It also emphasizes, as we kept noting, the importance of understanding the data sources, their reliability, like that owner estimate valuation. You really need the complete picture, not just the headline numbers. And that's essential for making informed decisions in this evolving space.
Right. For you listening, it's about seeing how all these numbers tell a coherent story and how tokenization might provide a new lens, a new way to engage with real estate investments, potentially opening up access to new kinds of opportunities.
And maybe this raises an important question for you to consider going forward. As these digital ownership models evolve, and as more detailed financial reports hopefully become more transparent and accessible, How might this empower a new generation of informed investors? And what new metrics or maybe new analytical approaches might become essential to track beyond just the traditional real estate fundamentals we talked about today? Something to think about.
Definitely something to think about. Thank you for joining us on this deep dive. Remember, this report, this discussion, it's all for informational purposes only. It does not constitute investment advice. Always, always do your own due diligence and consult with professional advisors before making any financial decisions. We'll see you next time for another deep dive.